All right, let's dive into a puzzle that has tripped up investors for, well, forever. We're going to use the timeless wisdom of the great Benjamin Graham to see if we can finally crack it.
I mean, this is the big one, isn't it? We have supercomputers, algorithmic trading, financial news blasting at us 24/7. We have more data than ever before. And yet, for all that tech, every market cycle feels like a rerun of the same old movie. Greed takes over, and then panic sets in. So, why haven't we learned?
This quote really hits the nail on the head. It points to this really dangerous idea that each new generation of investors thinks, oh, this time it's different. We convince ourselves that the old rules just don't apply anymore. But you know what? History is the ultimate reality check. It shows us that while the stocks and the tech might change, the one thing that stays the same is how we humans act when our money is on the line.
So our first stop is to figure out why history is such a powerful teacher. And listen, this isn't about memorizing the dates of old market crashes. No. This is about spotting the recurring patterns in our own psychology, because that's what really drives the markets time and time again.
I love this slide because it gets to a powerful truth. Financial history, it's not just about numbers and charts. It's about people. You can think of it as the biggest, longest-running psychology experiment in the world, just documenting how millions of us react to greed, fear, and total uncertainty. It's all right there in the data.
Now, to really understand the solution to this whole behavioral problem, we've got to go back, way back, to the crucible where the solution was formed. You see, Benjamin Graham's philosophy, it wasn't dreamed up in some comfortable bull market. It was forged in the fire of the absolute worst financial disaster in modern history.
And just look at this timeline. It shows you how bad things really got. The 1929 crash wasn't just a blip. It was the beginning of a years-long nightmare. A slow-motion collapse that didn't just rattle the financial world. It completely broke it and wiped out an entire generation of investors.
So these core principles were born directly from the ashes of that crisis. Graham saw with his own eyes that leverage, borrowing to invest, was a guaranteed path to ruin. He learned that raw fear can push prices to insane lows that have nothing to do with reality. But the biggest lesson of all, he realized that having emotional control, that was the real superpower. So his entire framework was built to survive the absolute worst-case scenario, not just a little bump in the road.
Now, I know what you might be thinking. Okay, that was the 1930s. Ancient history. Things are totally different now. But are they? Because these exact same lessons have been taught again and again right in our own lifetimes. Let's take a look at how Graham's ideas held up against the major crises of just the last couple of decades.
Remember 2008? The whole system was on the brink. And what were the culprits? The same old villains. Too much leverage, this blind faith in complicated models that nobody really understood, and this crazy overconfidence in assets that everyone thought were perfectly safe. And what made it through the storm? You guessed it. The boring, old-school stuff. Companies and investors with strong finances, simple and conservative portfolios, and the discipline to actually stick with the plan.
The lesson from 2008 could not have been clearer. Leverage, that's the weapon that turns a temporary market drop into a permanent, life-altering disaster for you. The principle from 1933? Yeah, it was just as true as ever.
And then came 2020. The pandemic shock was like a pop quiz on investor psychology. The market dropped faster than ever before. And what happened? People who panicked sold right near the bottom, locking in huge losses. But the people who had a plan, they just held on tight, maybe even bought more when things were cheap, and they got to ride that incredibly fast recovery all the way back up. I mean, this event perfectly illustrates one of Graham's most famous ideas, the market's crazy mood swings. They're not there to tell you what to do next. They are a test of your emotional control. A disciplined investor sees panic as an opportunity. An amateur lets the panic control them.
Okay, and then 2022 comes along. And it was a huge wake-up call for a market that had gotten really complacent after a decade of easy money. We'd forgotten about inflation and rising interest rates, but Graham's framework never forgets. It's built on the assumption that you can't predict the future, which means having a margin of safety, a cushion for the risks you don't see coming, is everything.
So after looking back at all these different crises, a really clear pattern starts to show up, doesn't it? The real reason we keep making the same mistakes. It isn't the economy, it isn't the news, it isn't even the market itself. It's us.
And here they are, the classic blunders. We buy high because we're afraid of missing out. We sell low in a fit of panic. We get seduced by exciting stories instead of focusing on the boring math. And worst of all,
We abandon a perfectly good strategy the second it gets tested, which is ironically the only time it really counts.
This is such a critical idea for anyone investing today. We think our fancy apps and instant information make us smarter, but a lot of the time, they just amplify our emotional mistakes. They let us act on our worst instincts faster than ever before. The technology changes, but our basic human wiring, that stays the same.
Okay, so if we know the problem is our own built-in behavior, then the solution has to be a system, a framework that acts like a defense against our own worst instincts. We need a set of principles that has stood up to every single test history could throw at it.
And this table is basically the ultimate cheat sheet. Seriously. On one side, you have the things that history always rewards, having a buffer, spreading your bets, and just being patient. And on the other side, the stuff that always gets punished. Leverage, being overconfident, making things too complex, and thinking you can predict the future.
And here it is. This is the single most important lesson from this whole journey through market history. The world, the economy, the markets, they will all continue to change in ways we can't even imagine. But the principles of intelligent investing, which are really just the principles for managing our own behavior, they never change.
So I'll leave you with this final thought. The next crisis, it's not a question of if, it's just a question of when. So the only thing that really matters is this. Is the strategy you have right now built to survive that storm, or are you sailing a ship that was only designed for calm seas?